What's up, digital wildcatters? Welcome to another week of Big Digital Energy. This week we got Mark Myers, we got Sean, and we got Kirk. Kirk's still joining us remotely over in Nantucket. And then I don't know where Chuck's at.
Is Chuck on a runway in Milan modeling the latest in
hoodies,
in girlfriend approved fashions? What?
Chuck is trying to bring the ripped jeans and hoodies look to Italy.
I actually think he's at the national or the international prostate conference because the doctors are really impressed with his ability to talk about and show his prostate to others.
If this show's ever going to get taken seriously, we have to drop the prostate jokes on Chuck.
PSAs for
no,
PSA.
Actually, that's why people tune in, actually.
Note to self, don't ever miss the show.
Yeah. All right, Mark, what do we got on the docket today? What's our first story?
Well, we've been out for a week, so I think what happened last week and continues today on the oil macro side and how it relates to the equities. Sean and I had been going back a little bit over the weekend and this morning, and I asked him if he thought it was a pivot. We've been talking about this markets and show me as it relates to energy equities, and it needs to see definitive evidence that inventories are drawing, that demand's okay. I don't know that we'd call it a pivot, but you're seeing some at least constructive results out of the first couple of bellwethers that have either pre-released in the case of Chevron and Schlumberger, which reported last Friday. So, yeah. Sean, you had some comments on that.
Yeah, I think as we go into the second half of the year, it was just a timing conversation as it related to global inventories rebalancing. And China came out a lot slower than everybody expected. There was a lot of concerns about recession. The Saudis made some very proactive cuts in terms of the 1 million barrels a day, and they're going to continue to do that. But, I don't think it's a pivot yet because there's still a healthy amount of anxiety about what does energy look like over the next 12 to 18 to 24 months. What I said to Mark was, if you look at fund flows over the course of the last 12 months, $24 billion has gone into tech, $20 billion has come out of energy.
Dang.
And so that really accelerated in January of this year. And to me, it just seems like people are pairing at the fringes and trying to reposition more into energy versus where they were before.
The fund flows from energy to tech are something that are interesting to me. I was talking to a top tier VC fund the other day, and they were talking about how from a macro perspective, they're actually bullish on energy and want to be investing in energy tech companies instead of, your traditional Silicon Valley tech companies. And so I thought that was interesting to hear how there may be a shift in private markets and early stage venture capital, and it may start flowing a different way eventually.
To me, that is one of the most attractive opportunities out there. Like you talk about a lot with energy technology, and as these companies continue to consolidate, they're going to try to do and will continue to do more and more to extract as much margin per molecule. That's what it's all about. And what energy companies have been able to do, and it's one of our core theses in our firm, but what energy companies are trying to do is to say, look, I don't have to be reactive to commodity prices every day anymore. I've got a relatively religious capital discipline model. I'm living off of some free cash flow. Some periods it's going to be higher, some periods it's going to be lower. All that to say, it's enabling them to go in and do things that they've never been able to do before with respect to technology and automation or improvement of their own systems. So I think that if you can get in there and start allocating capital and creating things that have commerciality and scalability to improve the carbon footprint of traditional energy, it's going to go a long way in terms of that actual absolute move to lowering our carbon intensity. So I think it's a huge opportunity.
Mark, you asked me before we got on the show if I had anything to talk about, and I said no, but I actually do. I always got something to talk about. But
the floor is yours.
So I saw this quote, and I think Kirk liked my tweet because I tweeted it out, but there was a story in Bloomberg from the CEO of Ørsted, and they said capital costs and prices for turbines, cables, and other equipment have gone up sharply. And this means that the price of renewable energy regrettably must come up temporarily after years of steep decline. And that just what you're talking about kind of triggered a catalyst for me to think about that, because there's, like you said, a lot of unknown in what energy looks like over the next several years. And the past several years, I've had a ton of people on Twitter telling me that essentially any inflation in material costs doesn't matter in renewables. And it goes against basic economic principle that if build cost goes up,
right,
energy prices have to go up as well. And it was to the point of like gaslighting, where these people are like, no, it doesn't matter. I'm like, how can it not matter when, the price of natural gas is going up, the price of diesel is going up, the price of metals are going up, and that affects the entire supply chain. And I think people's argument is, oh, well, once you build a renewable asset, it's good for 25 years. One, I think that, that's a little bit questionable if you're getting 25-year lifespan.
I mean, not an oil and gas project doesn't last that long. But.
And Siemens came out a couple of weeks ago, and they actually had to revise their forecast down because they're seeing billions of dollars of incremental costs that they have to incur now on an annual basis, just from a maintenance perspective.
Did y'all see that video with the director of Siemens on Project Veritas? Did y'all see this? So y'all know Project Veritas, the one that does all those undercover interviews. Well, this guy's like, he's a director or some, equivalent position at Siemens. And he's talking about how ESG is just a grift. And he's like, if you look at where we really make our money, it's in gas turbines and things of this nature. He's like, but you play into the ESG thing because you have to. And I thought it was interesting that Project Veritas is doing something focused on like energy, because they're usually like very political,
pharma.
Pharma.
That was the big,
like Twitter. They were doing it with Twitter, but so I saw that, and then there was another renewable developer that pulled out of a project, and I think they had to pay like a $40 million fee.
Vattenfall. So last week, Vattenfall basically stopped their project off of the coast of the UK, citing that there's a 40% rise in cost of the project, and basically their investment, it's a 1.4 gigawatt project. They're halting an investment that's between 10 and $11 billion, and they're saying that costs are just out of control. And developers have said for months that projects with low locked-in electricity prices have become uneconomic because of the price of wind turbines and supply chain problems in the wake of the Ukraine war. But really, we know that these costs are going up off the board, and
that's
and these
developers are bidding for very low electricity prices because the government's running these auctions, and they're just not economic.
And
something has to break.
These are direct items of inflation impacting results today.
Yeah.
In the conversation, you sent me an article shortly before the show about it really gets at the full cycle cost,
correct,
and the whole levelized cost discussion. There's a study in Australia about some arbitrary cutoff of all of the very necessary thing. They call it firming power. We call it available dispatchable thermal power. Obviously, transmission and grid upgrades that are billions and billions of dollars. Anything up to 2030, those get put in the sunk cost bucket. Otherwise known as you should have known better than to make those investments. So all that capital is on you. Well, in the regulated utility world, all that capital is in a rate base, and the rate payers are guaranteed a rate of return.
Well, and take it a step further, right? You think about the incremental costs, and I'm not trying to bash on wind, right? That's not the agenda here. But where I get tripped up here is when you look at the full cycle environmental impact and the full cycle life of wind turbines coming from hydrocarbons. They're not recyclable. The maintenance that goes along with them. You start talking about the economic ramifications. Well, if your gearbox goes down and you have to replace that, even though it has a 20-year useful life, Is that maintenance CapEx or is it an operating cost? It's an operating cost.
Mm-hmm.
And so that means that your return on investment should be going that much lower because that's a direct impact to your operating cost.
Yeah.
And it's and another quote that I thought was interesting. We're talking about Europe, like the UK versus the US. One of the things that I think gets lost on people is when you think about renewable technologies in the wind or solar, if you will, in Europe, and the costs, they have a higher threshold for paying because their energy costs were already so much higher than they are in the US, right? The US is well endowed with natural gas and coal. So our energy prices are historically significantly lower than what you would see for renewable. And the notion that all of a sudden it's okay to take 20 cents a kilowatt hour and embed it into an environment where you can get 10 or 11 cents a kilowatt hour, no one's going to like that, right?
Yeah.
And so but it speaks to the value of having resources in place, and you've got to understand that economic cost to the consumer.
Well, I think, Sean, you said we're not bashing wind or solar, which is I want to make clear, not just biasly being an oil and gas boy here that's bashing renewables, but all the things that we've been talking about for the last few years, you're starting to see come to fruition. And I think what's interesting is, everyone, even, Skelly got up on stage at Fuse and said, hey, if you think that 100% of electricity is going to come from renewables, you're out of your mind. I mean, that's the OG when it comes to developing wind and solar assets. And I think a lot of people think that renewable asset generation is going to continue to increase at a linear pace. But if you really think about it, they're attacking all the low hanging fruit, and it only gets harder over time to find economic projects. And then on top of that, rising costs with inflation. What you're talking about with the gearboxes, I think that the renewable industry is really going to learn some painful lessons that oil and gas learned about replacement costs, and trying to, once you start hitting those 20, 25 year marks, now you're having to replace and try to just keep baseline production. And those are all the things that you talk about now, and it's easy to ignore them and say that they don't matter. But then when they start happening, and I just think that it's crazy to see some of these big projects getting pulled offline because it's a lot faster than I anticipated. And so you might start seeing a slowdown of penetration of renewables in the market.
Because we have a lot of supply. There's a lot of generation supply that's been created, whether it's wind or solar, but we still can't fit it into the grid. So let's talk about the relevance of that. Right? How much more? I've had this conversation with a guy who does electricity power contracting this morning. He said, "You've got plenty of supply. We just can't get it into the grid, and it's intermittent." So, as I think about as I think about the evolution of energy here on a go forward basis, we're talking about wind and solar now in terms of clean tech. That's the euphemism, but it's really battery technology and smart grid technology and things like that that are going to truly move the needle. And that what those things will enable you to do is to utilize a lot less of a renewable footprint, like a solar footprint, because you'll be able to store power over a period of time. In 5 years, we might not even be talking about some of these.
Yeah.
We've talked about this before about the major queuing problem of at least the US grid. And we have that data. We never posted it, but it comes from Wall Street Journal and someone else. I think Bloomberg posted a few data stats as well. You're absolutely right about we have plenty of supply. Back in the days when I was at the big oil major, it was interesting watching our offshore wind teams bid for projects because economics has to drive the equation. But what I've learned from working in sort of big, large companies is that you always want to win the bid with the lowest bid, and then you figure out how to claw back money. And I think what these developers have been trying to do is claw back incentives and subsidies, and those incentives and subsidies are just not there. Yeah. In fact, the CEO of Dong Energy, Ørsted, I don't know how many people remember it used to be called Dong Energy, but Ørsted says it's inconceivable that UK projects weren't struggling. Everyone knows that it's sort of everyone's bidding for this low cost of energy, but the math and the expenses don't justify it.
One of the fundamentals to all this and bringing up batteries being really the key and providing the storage foundation is that, and we've talked about this as well, their fundamental building blocks, particularly in a couple areas like nickel and copper, are facing a real inflection in demand.
Right.
And what we've seen, at least from existing operations worldwide, is a consistent drumbeat of degrading ore quality, which then portends more intensity of digging, processing, transporting, et cetera. We got to dig more stuff up for the same kind of yield. So, it's all connected, and it all has an inflationary dynamic related to it. And so just kind of eyes wide open there.
And bring that right back to the point that Colin made earlier was that's where these VC firms, I think some of these energy tech firms can do a lot and make a lot of money, is you keep adding and adding and adding. If they can figure out a way to make what we have that much more efficient and optimize what are the existing systems, that's the home run, right? Because there is a lot of energy. There's a lot of wasted heat. There's a lot of wasted electricity. Your point, like we're never going to be 100% electric, or if you will, or renewable, however you want to find it, because you need hydrocarbons to make the lights to turn them on, right? It's just but it's the improvement in efficiency. That's where I think there's that's a real growth area for energy as an industry in the equities on a go forward basis.
Yeah.
So I think anyone will tell you, any executive will tell you, is it scalable and is it commercial? And that's the hardest thing, to take something from the lab and make it scalable and commercial where you can actually utilize it.
100%. Why are you just looking at me, Mark?
Mark, did I steal your thunder?
No, absolutely not.
Okay.
Mark side-eyes me like I
brought you as the thunder.
So, there was this other tweet that I saw, and this was 2 weeks ago, but we missed last week's show, so I get to bring it up. But this guy had, he tweeted something along the lines, I was looking for it on my phone, but I can't find it. But he tweeted something along the lines like, how bad would it be if we had intermittent blackouts if we wanted to be on all renewables and get rid of hydrocarbons? And I was up at like Friday at 10 p.m. and like wrote this long tweet about it. And I'm like, I have nothing better to do with my life than tweet about energy policy on a Friday night. But it's something that's important to talk about because, for a long time, I've talked about the cost of renewables, and people always talk about, hey, renewables are cheaper compared to oil and gas. But the problem is that they only look at it on a power generation basis. So they look at it at the asset itself, but then they don't take into account for things like battery storage or backup nat gas generation. So you don't have this whole inclusive end-to-end cost for what it costs a consumer to have.
And then you have the electricity lost on the line loss from transmission,
like
aged transition grids.
Yeah. And so, I bring that up sometimes, and always the default response is like, oh, okay, well, I understand that, but oil and gas should have to account for the negative consequences of climate change that it costs. And so you have these phantom costs, these phantom accounting of we want you to add additional costs to oil and gas production to account for any damage to the environment or climate. On the flip side, this guy's idea is like, hey, what if we get off oil and gas and have 100% renewables, but we're going to have intermittent blackouts? My thing is, if that's the case, then you need to account for, the degradation in reliability for energy. And I made a little quip at ESG at the end of that. It was like, E's not the only letter in ESG. You have social and governance too. And, you can't base power systems and energy systems around, hey, are we all right with receding in our quality of life?
This was this past weekend, or leading into the weekend, the LA Times had a big piece on, should we just live with more blackouts or do without in order to solve climate change? And so you look at
I love
the
love
acute
these
practical negatives
sort of,
of turning off power in the midst of a heat wave, especially for elderly people. For example, intermittency does have immediate life and death. Without backup generation, has immediate life and death type of implications.
There's 3 billion people in the world that just want to have the option.
Right.
So,
Yeah.
I mean, I think that.
Well, there's almost 1 billion people that don't have electricity.
Correct.
So,
Yeah.
let's take that into consideration. But I have a question for you guys. I asked this question last week, actually, of someone that asked me about living with blackouts. And I said, do you have a generator? And they said, yes. I said, exactly. It seems that you should ask everyone that says we can live with blackouts on whether they have a generator. Because many times, whether it's a generator or they live in a climate like, for instance, where I live right now, where you don't need a lot of electricity because it feels pretty good outside.
Yeah.
Of course, you live off your cell phone for, I guess you wait until you get power back so you can use your cell phone again. But the reality is, it's interesting. It's only for like the top 1% that tend to talk about these crazy radical ideas when most of the world is just trying to, find food and raise their family.
Yeah, to be fair, this guy that asked that question, I think was a journalist, and he got ratioed pretty hard from both sides, not just oil and gas, but from
Colin's
renewables
followers.
Yeah, from renewables too. It's just like, this is a stupid question, even if it's just theoretical. It's not a possibility. So, anyways, lots of I always count on Twitter to bring in some good humored stupidity to the show.
So we're starting to see.
Hey, I'd like to throw in Go ahead, guys. I was reading about. We're talking about Q2 earnings, and I was reading about how Chevron has waived the mandatory age requirement for the CEO from 65 because Mike Wirth is 63.
Right.
And I realized that others have been doing this. JP Morgan offered Jamie Dimon $50 million in a retention bonus, and he's 67. Bank of America chief Brian Moynihan, 63. BlackRock's boss Larry Fink, 70. Warren Buffett's 92. Any thoughts about sort of we talked about this great generational crew change in oil and gas. Is it going to continue to grow even worse as we continue to let sort of the old guard continue to run the companies? What do you guys think on the equity analysts?
Well, we're just following the trend of the demographics of our elected leadership at the national level, especially, right? Congress has gotten a lot older. Certainly the administration is up there as well. I do think in one of the first podcasts I heard you on, Kirk, you talked about coming from an environment where upward mobility was, pretty unfettered, and promotions and opportunity accrued pretty quickly. And that just has not historically been the case in oil and gas. I certainly think the messaging of these things, like extending the tenures of CEOs past mandatory or statutory retirement age, statutory in terms of their own policies and regulations, is certainly a signal. But I think it's going to just have to happen, or the industry, because of the things that Sean talked about earlier in terms of deployment of technology and getting better through digital and data and technology, is going to have that generational turnover in terms of not just the doing roles, but also the decision-making roles.
Well, and Mike Wirth is an exceptional CEO, right?
Yeah.
And Mike Wirth has taken Chevron and done a lot over the last 5 to 7 years. I mean, he was one of the very first early adopters of understanding governance, the G part, which is what got the energy into trouble. Like, they were one of the first movers in terms of trying to figure out executive compensation relative to returns. That goes to the days of a former mentor of mine, Doug Terreson, who ran the Pledge. But he's done an amazing job with Chevron. And so to me, it speaks to, if you've got the talent, you keep him around. And he's still very capable. It's a mandatory, or it's an arbitrary age. And if he's willing to do it for a few more years, then you keep him, and you hopefully build up a bench behind him. Right.
Mm-hmm.
So I think it's a very case by case basis. And I don't know that it's a trend per se, other than the challenge of that next level of leadership and energy, because there's going to be a huge gap here over the course of the next few number of years, where we just don't have the depth of resource that we used to, because labor remains a huge issue.
Mm-hmm. No, absolutely. I mean, you're starting to see that issue. We've been talking about great crew change for 15 years now.
Right.
But
Never seems to happen.
Yeah. But you actually see it starting to come into effect. So, Mark, did you in this episode, real quick, we're getting a little long in tooth here, did you have a finger of the week?
I'm gonna tee something up, and we didn't get to a couple of things, but we are running a bit long, and bear with me. We're gonna bring Kirk back in to his expert perch as golf commentator on the heels of yet another major. In fact, the fourth major since they rearranged the calendar, if I'm not mistaken, Kirk.
I mean, it is the last major of the year, but it is the original major. And in fact, the Open Championship, which has traditionally been played in Scotland, and it has been in Ireland and England a few times. In this case, it took place in Hoylake, England. It started, its first major championship was done before Abraham Lincoln was the president of the United States. So it's been around for a long time. This year, Brian Harman won, our great lefty American. But usually the Brits are very arrogant about how the rest of the world, especially us Americans, are not classy, if you will. But in this case, in the Open, the fans at Hoylake were very rude to Brian Harman. They said a lot of derogatory things to Brian, and they started tracking, even on TV, the broadcast, tracking how many times he waggled. The funny thing is he just totally obliterated the field. It wasn't even a challenge. But Brian used that to his advantage. But it was really disappointing to see these classy fans really were classless in this case. And it really, I thought, put a blemish on the Open Championship.
And one of the more outspoken English tour players and champions, Ian Poulter, who's also known for a little sartorial extreme.
Who lives in Florida, but let's not say anything about that.
But he tweeted out this morning, Brian Harman, take a bow. What a class week. For all those that gave him shit from the stands and waggle meters on TV, and anyone else undermining his performance, you should be ashamed. He outplayed the very best. Now respect him for that. Waggle away, Brian.
What is a waggle?
Thank you for asking.
It's kind of what Wael Salon's doing at Shell. He's waggling his way and taking all the dead weight off the company.
You didn't have to relate it back to energy, dog.
I had to throw that in.
Show us a waggle.
It's basically what Barron's did this weekend. We're going to bring this full cycle with if Barron's had their cover story was about wind.
Yeah.
And one of the interesting things about wind power, this article, was it was not rah-rah. And I think one of the things that I'm seeing here is the people are waggling away the superficiality, and they are starting to become a lot more, at least aware, if not knowledgeable, about that returns on capital matter, and that none of this is going to work without a real viable business model.
Yeah, and on the other side of that, in the South, I don't know if y'all saw the Houston Chronicle from Friday, I believe, but front page was about abandoned orphan wells in Texas leaking. And so on the other side of that, you have Texas large newspapers that are starting to I want to say attack the oil and gas industry, but hold it accountable, which I think I personally think is a good thing for us as citizens.
The TCEQ, the Texas Commission on Environmental Quality, has been regulating everything in this space for a long time, and they have pretty strict standards. So I think that's a lot of hype. Well, having dealt with the TCEQ myself, I can tell you
there is a problem. I mean, there is. Then it's the abandoned wells that are supposed to be plugged and abandoned, right? Mm-hmm. And so there are ways, and they don't get plugged and abandoned, or they're not done as effectively as they can be. And so I don't know the order of magnitude of how much hyperbole is in that particular story or not, but that's just one of those things that is low-hanging fruit for the industry to do to improve their footprint. And I know a company down here that is signed some very interesting contracts to do just this. They're going in and making sure that over the long term, companies, they can remove that P&A liability at the early stages of the well life. And that way, you know that it's going to be.
Yeah, Tony Sanchez is doing that.
Tony Sanchez is doing it. Yeah.
Which I actually think is a really good idea. You know, love or hate Tony Sanchez, I think the idea is actually good because they're treating it like it's an insurance company, and essentially they go to an E&P, and E&P pays them a premium throughout the lifespan of this well, and then when they want to P&A it, they just assign the well over to Tony's company, and they'll take care of the plug and abandonment and take the liability from them. And during that, you know, that whole course, they're taking the premiums and, you know, getting a return on it. Mm-hmm. However, you know, they're investing that. But I actually think that's a pretty clever idea.
Awesome.
And there's a spectrum of mitigation things that the industry can and should be doing much more proactively and much more aggressively. We talked about routine flaring, which to me is somewhat of an oxymoron. Fugitive methane and wellbore abandonment. Mm-hmm.
Yeah.
There are controllable elements in scope 1 as well, just generally. So a lot of distracted time spent engaging in a political debate on things that will never get resolved, like scope 3, or getting out over your skis and spending time and money on putting together strategies, programs, and policies only to disappoint, which then further reduces your credibility when you have to backtrack those things.
Well, and at some point, I don't want to go down a rabbit hole, but to carry off of that, I read something this morning on Bloomberg New Energy, and there's been a lot of conversations about solar panels, like domestically manufactured solar facilities, how it's the way to go, and this, that, and the other thing. And there's been a lot of money thrown into that. The challenge, though, is that the Chinese in particular are able to get those costs significantly lower than what even these domestic companies can do with the subsidies. Mm-hmm. So you're spending all of this money in an industry domestically where you're still going to get run over by the low cost supplier from another market who, by the way, has attractive logistical access to a lot of the minerals that Mark was referencing that you need for processing all these things. Yeah. So it's throw good money after good, not good money after bad. Solve the problems.
Yeah.
And I wonder what their cost of energy to produce is.
Right.
Using all those coal plants.
Yeah, using all the coal plants.
Right.
All right, guys. Solid show. Sean, appreciate you joining us today.
Pleasure. Thank you.
Kirk, appreciate you calling in, taking time away from your surfing. We will be back next week. If you enjoyed the show today, please share it with a friend, share it on LinkedIn, share it on Twitter. We always appreciate the messages that we get from y'all and the feedback and comments. We will catch y'all next week.